Hi, everyone. Welcome to another edition of Macro Matters, where we talk about the macro that matters to our CFA members and our guests. We are here on February 5th recording on what's going on in the markets and what's going on across the world. I'm joined by my colleague, as always, Tony Zhang. Tony, welcome.
Yeah, hi, Rich. Nice to see you. And I think over the past couple of 2 weeks, it was we start to see some transitioning of the market, different from the first half of January. There's like a lot of interesting things that we can discuss, and I look forward to discussing with you this time.
Yeah, I think you're absolutely right. There's a lot of interesting things to discuss. This is, we
Yes.
we talked about at the end of last year and beginning of this year that this is going to be one of those super interesting years, and I think that we're just at an inflection point in the economy. We're an inflection point for rates. We're an inflection point for politics. We're an inflection point for geopolitics. There's so many things that are going on, and it's always a question of like, where do we even want to start? But where I want to start this week. I really want to cover two things. One is the Fed, because we had the Fed meeting last week, and we've got Jay Powell on 60 Minutes last night. But
Yes.
I also want to talk about earnings too, because ultimately the way I look at it, and I think you would agree, Tony, is like for equity investors, the Fed interest rate decision is going to impact the multiples, and the economic data and earnings are going to impact the obviously the earnings level. So the PE times the E is going to ultimately equal the P. So we need to kind of focus on both of these things. But first things first, the Fed, right? We had the big press conference or the announcement of no change, which surprised nobody. But then the press conference started to sound a little bit more hawkish than people were thinking, with Chairman Powell saying no rate hike in March, and then Chairman
Correct.
Powell doubled down on 60 Minutes last night and said basically there's no chance of a hike in March. Maybe I'm reading between the lines a little bit. What do you think of what you heard from the Fed in the past week or so, Tony?
Yes, Rich, you are 100% right, and this is not surprise to us, Rich. I think in our previous two section about the macro matters episodes that we already talked about that market already really priced in that Federal Reserve is going to cut the interest rates in March. But based on our experience in the past 1 year, we know market is always over optimistic about the reality, and Federal Reserve actually did not take action as exactly as what the market would anticipate or expect, and it never did in the past 1 year. And with regard to the rate cut in March, this time, there's many, I think, investors or many institutions would expect just because of the cooling of the inflation, especially from the number that we saw that came in November and December, we start to see some cooling of the inflation metric utilized by Federal Reserve, and every people would think that Federal Reserve will respond promptly with the cooling of the economy, so that would actually help the stock market, equity market. And but during the last of the FOMC meeting, once especially when he started to give a confirmation that it's unlikely that Federal Reserve it's immature to take the rate cut in March, that the market start to actually come down and sharply, right? We saw the sell off from a rally to a sell off within just maybe a couple seconds, just right after he comments about this is unlikely to have rate cut. This and now last week the employment data and wage data came in, which actually further affirmed this is really Federal Reserve has no reason to really cut the interest rate given such a very strong fundamental of the economy. This is now the chance for the rate cut has went down significantly from almost like a 43% down to roughly about maybe 13% based on the Fed watch that what we have seen. Now markets start to realize it's unlikely. We start to see the trade-off between the Federal Reserve's policy rate
Yeah.
simultaneously with a strong economy, which actually whether the strong economy will be converted into the earning, the strong earning of the company that Rich you just talked about.
Yeah.
Based on I think based on so far that most of the data that actually already coming in, that what we have can quickly summarize just by I think by last Friday, we have seen that more than 70% of company that have actually uh, beating both the analyst revenue revenue estimated and also the earning estimated, especially like from the Magnificent Seven point of view. We saw Amazon and Google and Meta, especially Meta, right? Actually,
Yeah.
just bit the earning dramatically in revenue growth. It's very amazing to actually to see this kind of a Magnificent Seven company having a double-digit growth rate under such kind of environment, under such high rate contact. It's just so good. So they actually tell us that it's almost certainly that Federal Reserve is not going to cut the interest rates in March unless some emergency happen. The emergency could be something like a pandemic, or could be some maybe geopolitical tension, like a war happening somewhere. But otherwise, I see little chance for them to happen. Now, coming back to the earnings, what I pointed out so far, I think half of the S&P company have already finished reporting. Uh,
Yeah. I agree. I
reporting
think
earnings,
it's right
right?
about half.
Yeah, half of the company. And so far, what I have been seeing is still the earning remain to be strong, and remain even the guidance actually tend to be stronger, and actually come into much better than many analysts had already estimated. In last quarter, analysts continued to actually cut their earning expectation for the Q4. They might really think that Q4 might be the worst quarter, it's like over the past 1 year, but it turned out to be now, with the 50% of the S&P company reporting, we saw that most of them, like 65 to 70% of them, are doing way better than the earning analyst expectation. So if this trend can continue, then by the end of this year, the earning per share expectation in a strong economy will become stronger, then actually provide the foundation for market to, especially S&P 500 company, to actually to reach to a new high. That's my take. How do you think?
Yeah, there's a lot there I want to unpack, and I think a few things I want to kind of talk about is so first of all, I want just for those that are on, or they're listening instead of watching, um I was going to maybe try to share a screen, but maybe so I can't really share the screen right now. But really, what I've been looking at, and what I wrote about on LinkedIn today, and what I wrote about on Substack over the weekend, Tony, is this idea. I looked at the 2-year Treasury yield. Right, the 2-year Treasury yield is where a lot of macro investors have been leaning long, right, and so that's because of the bond math that was involved. There was very little downside, and if the Fed cut rates, there was a lot of potential upside, right, in a rate cutting cycle, and so a lot of people were long 2-year bonds, and those bonds rallied very, very sharply in the last 3 months, very sharply. And this coincided with a sharp rally in the S&P 500, which was driven almost entirely by an expansion of the forward multiple for stocks. So,
Correct.
rate expectations moving lower, investors getting more confident, multiples expanding. It wasn't driven by earnings. We know longer term that it's always earnings that drive stocks, but we also know that the multiple expansion can lead that earnings growth that you were kind of referring to. And so investors were seeing these rate cuts, anticipating earnings growth to come through. And so that the rate cuts that were getting priced in, we saw that in the 2-year, and the multiple expanded back in, on a forward basis in the S&P overall, above 23 times in aggregate, above 30 times for the Mag 7. And so it was pretty meaningful. And it was a sentiment driven rally, and towards the end of last year, and even through this year. In the last 2 days, starting on Friday, really, after the jobs number. And then today we're seeing a continuation after that Chairman Powell's 60 Minutes Not only Chairman Powell, but then Neil Kashkari, which I know some people will say, okay, well, it's just Neil Kashkari. He can be all over the place. He's certainly a hawk right now. But what he talked about was that the neutral rate is actually much higher than they were thinking. And so that maybe the policy isn't as restrictive as some people think. And so the idea there is that, the Fed isn't it isn't really restrictive. We see that in financial conditions. So the Fed doesn't have to be in a hurry. So it's not just, yeah, you're right. If we went back to January 15th, there were still probably three-quarters of an odds were like probably 75% a couple weeks ago that we were going to get a rate cut. Now in March, it's almost fully priced out. But it's not just March. It's like if you look across the curve over the course of the year, about 1.25 cuts have been priced out. So it's a little bit more than just the March that's coming out right now. As people are saying, maybe the Fed dot plots are a little bit more accurate than what the market was pricing. And you remember the market had 6 rate cuts at one point. It
Yeah.
still has 4.5 rate cuts or 4.6 rate cuts priced in. And I think there might be scope for that to move back towards the Fed dot plots at 3. And we can talk about at some point. I think because given the change in voters that we have, and when we get the new dot plots in March, it might even be less than 3. But that's purely speculative. But I think we have seen people like Austin Goolsbee, who's very dovish, roll off, and we've seen others kind of move on. So that excuse me, that's one of those things where I'm watching that closely because that's been really what's driving the markets right now. And when you talk about earnings, when we look at the aggregate numbers, they look pretty good, right? The aggregate numbers look good this year. In fact, if you look through what it looked like for all of 2023, we're seeing pretty solid S&P earnings growth when a lot of people were expecting earnings declines, but it's all the top 7 names, right? It's like 50% plus earnings growth in the
Correct.
Magnificent Seven, whereas the other 493 are in negative earnings growth territory. So we are seeing an earnings recession. We're just seeing it, in the 493, and the other ones are big enough right now that they're just carrying the day. And if we look within that, if we look at within the numbers, what do we see? We see top line numbers are still looking good for companies, but margins are decreasing, right?
Yes.
And margins are decreasing because of inflation. And I think that's a persistence of inflation. And we see that wage growth has been a problem, right? We saw that in the average hourly earnings data on Friday. It was much, much higher than expected. Wage growth has been a problem, and wage growth lags inflation, right? People feel the inflation and they ask for rate hikes or sorry, wage hikes. But we saw all the headlines throughout all last year, and finally that stuff is starting to kick in. And one of the other things I think that we could, or actually I'm going to kind of share a couple things with you here. Alyssa took care of me and sorted out the me being able to share the screen. So for those who are looking at, I'm just kind of showing a chart here of which companies have had the most aggressive layoffs the last 2 years. And if we look at that, the technology and consumer, which is being led primarily by Amazon, and healthcare, 3 industries that have had by far over the last 2 years the most aggressive layoffs, and these are by far the most labor intensive areas. And so these are the ones that are being hurt the most by inflation. And if we look at technology and consumer and we look at their earnings this year, they're the ones that their margins are holding up the best. They're the ones that are not getting squeezed by this inflation on their margin. That's why their earnings have been the best, and that's why people are flocking to those sectors. If we look at at companies on the other end that haven't had layoffs, real estate, industrials, energy, these are high fixed cost businesses, and these high fixed cost businesses, typically labor is a smaller part of it, and so they haven't really had the need to do any layoffs. But at the same time, their earnings are not holding up nearly as well. And so I want to see if I have it, if this is it. Oh, that's not it. Sorry. I was just try to find that other chart. But so I think when we think about the earnings and margins, I think that you're right that things are looking pretty good this year. But I think the inflation that's coming through the wage data is probably giving the Fed reason enough to pause, and I think that's something we might continue to see kind of going through here. And one other thing is I think this was data that came out from Bank of America in the past few days or so. They do the survey, the global fund managers, et cetera. And they were saying that right now across their global investor base, 75% of investors think we're going to have a soft landing this year. 20% think we're going to have no landing this year. And only 5% think we're going to have a hard landing or recession. And so I'm not saying we'll have a hard landing or recession, Tony, but I think the odds are probably higher than 5% that we're going to have a hard landing or recession. And if we do, investors are clearly not positioned for it. And so I think when we think about the potential risks in both bond and stock markets, that's something we have to be aware of. And that's the scenarios we've talked about before, right?
Yes, Rich, you're definitely right. Like for financial investors, especially institutional investors, that we need to actually compensate for will be to protect the loss from the fat tail risk, which will be if we actually did get into the hard landing, what could be the potential loss? And
Yeah.
is there any way that actually we can actually prevent them from happening? I think this is from institutional perspective. But there are a couple things that, given what you're saying, that either market is efficient or market is inefficient. We know the sentiment factors definitely, behavioral finance, the sentiment factor definitely play a major role for us, given majority of the both retail investor and institutional investor expect that we will have a softer landing. This might be the high probability thing, and that's how the market would price in. This is more critical issue will be that I I really believe that market might underlook this is what the potential for the hard landing. And based on what we have discussed from a quantitative analysis perspective, every time when the uh, yield curve spread turn from a negative to zero,
Yeah.
the recession always happen.
Yeah.
And we here now we definitely can argue at this moment it could be the generative AI new technology trend that come into and rescue the economy and rescue the market. Over the past, many of the financial economy, what we have seen is the market, financial stock market, actually respond to the economy. Basically, they project that company might actually start to see some recession going forward. Then market actually would respond or precede earlier than the reality. Market might go down way before we saw the economy recession. This is in the past, but because we're going to have a recession, and they think this is going to happen now, in this situation, with the advance of the generative AI, it could turn out to be a slightly different thing. It will not be the economy transitioning into the shrinking of the earning per share of the company or the revenue that actually leading to the market down. This moment, it might be because the other way around. It could be any issue that can happen on the financial market would cause the company to respond, either laying off people
Yeah.
or either actually cutting off this cost, then leading to the recession of the economy. Now, market actually reached the all-time high, financial market, equity market. That's what we have already seen. Now, this is like very fully priced in the soft landing or even no landing scenario. But any mistake happen can quickly just reverse the whole process, and it will become the scenario that we have never seen before. The collapse of the financial market caused the recession in the real economy. I think that the most likely this could be the case this time if we eventually happen, Rich.
Yeah, I mean, that's a great point. I mean, I tell you, Tony, I've been talking about this with a lot of people anecdotally just as I go, as I live my life, or the last month or so, it definitely feels like the late 90s, right? Every restaurant,
Yeah,
every store, everywhere I go is super packed. Stock market near all-time highs. It definitely has that buzz, even though you can see that there's some economic data, there's some global data, there's some Fed reasons why it shouldn't be the case. It is. And that, so you're always saying, okay, what would be, what would be that catalyst, right? What would be that match that lights the kindling that could get this to happen?
Correct.
And we've gone through a number of those, and we always climb the wall of worry in the stock market, et cetera. But to me, it was pretty telling when last week we had New York Community Bank, we had the Japanese bank Aozora, and we had Deutsche Bank all have negative news on U.S. commercial real estate, particularly in New
Very
York. That was all very, very negative news. The banks themselves, their earnings were okay this year because they were some of the earlier reporters, because their bond portfolios had rallied back at the end of last year, and that's one of the things that kept them underwater. But to the extent that those bonds start to sell back off, and we know that their ability to go back to take those as collateral to the Fed ends in March. And we know there's a commercial real estate problem that was supposed to start a little bit last summer and is going to go really for the better part of 3 to 5 years. We're only in the early innings of that being a problem. And here we have, again, three pretty big banks in this area are telling us that things are not good. And the anecdotal headlines we look at, I just saw that in the Chicago real estate papers that there's a building in downtown Chicago in the central business district that traded 90% lower than where it was last marked in 2018. I mean, these are prices, and these are levels at which the prices are so bad. I hear from a lot of lenders that they're getting much like, remember, 2007, 2008, where individuals were just mailing their keys back to the bank because they just didn't want to deal with it. That's what's going on in commercial real estate. And can this small banks are much more exposed to commercial real estate than big banks are. And if that starts to hit, that means small banks aren't lending, which means small businesses aren't getting access to any sorts of capital. And that's a catalyst that could happen. Of course, you know, AI could carry us through with tech and communication services, but at some point the real economy, as you're talking about the real economy having a recession, that it has to be carried through, and there's still a lot of things that could go wrong. But for now, when we look at the data, I get it. The ISM is, had some really good reports last week, and had the services number today. So when we look at the ISM data, which is coincident with the S&P, so it leads the economy, it looks like it's turning higher. The new orders data looks like it's turning higher. So you can understand why investors want to stay long. This is the right time if you think we're going to if you think there's going to be a soft landing or no landing. This is the right time to own stocks, right? It's usually the best returns, but I still see a lot of potential risks out there, and I think those risks just got brought more into focus because the Fed is saying that they're not going to be there in the near term to kind of soften the blow from that. And so that's something where I think we still have to be worried about that as we kind of think about it. So, again, we're not really changing the tune, but I think for us, to me, I think the market is shaking off this Fed news on Friday and on today. But I think this Fed news and what that means for short-term interest rates might be a particularly large driver for riskier assets as we look into look into February and early March. That this is something that every investor should have on their horizons.
Yeah, very true, very true. Now the chance for the Federal Reserve to really lower the interest rate might be the odd. It will be in the May for the first cut, right? The second cut might actually came in June, just based on the market pricing information. This could still be the case. However, it has already been longer than what the market anticipate initially, that we're going to see the first rate cut in March. Now, this will give pressure to a lot of small cap and mid cap company with high cash duration, as what we discussed previously. Now,
Yeah.
even the market actually reached to all-time high in S&P and in tech, but it mainly just because of the tech sector. And then more narrowing down, it mainly just because of those few Magnificent Seven, but Magnificent Six, because not Tesla, right? This is
Yeah.
not Tesla. Mainly, this is kind of a sick company or some tech company that leading to the growth of the index, but it's underneath the water. Many sector, including industrial, healthcare, especially you mentioned about the real estate, house, those kind of a sector are under tremendous of pressure. It could, just from the technical point of view, Rich, you are an expert in that. From a technical point of view, you are almost getting to a point that could easily break down, that actually signal to me the weakness of the financial sector going forward, just over the next few months, or at least another quarter. But Federal Reserve will continue to cut, I think 4 to 6 times this year, given the high interest rate environment. I think the high interest rate would definitely put a lot of burden over over the federal government to continue for them to borrow the money, especially running under the fiscal budget deficit. I think that's what really drive this economy so far. It's because the federal government continue to take is still stimulated the economy with the strong fiscal policies.
Yeah,
But
no, that's a fair point, and I think though I don't know, it's so hard to say. I mean, to me, we're at the point of where we're not going to get a rate cut in March. I don't think we'll see rate cuts in September, November for political reasons. I don't think the Fed
that's
will want to
correct.
be accused of being political. So that really leaves 3 meetings where they could cut rates, and so they would have to at this point cut rates at every one of those meetings just for them to meet their own dot plots. And so,
Yes.
um, and the data doesn't necessarily support that yet. I mean, we'll get more data well before May, so they could start to turn by that point. But
Mhm.
I think as risk taking investors, we have to consider the possibility that these rate cuts just won't be as strong as what the market's pricing in. And we've talked before that the scenario of soft landing and aggressive rate cuts, which is what the market has priced in and continues to price in, um, we might very well get a soft landing, but I just don't know if the rate cuts are going to be what people thought. And that's kind of where I am right now is we'll still get a soft landing. But I don't see many rate cuts. I think less than what the market thinks. And of course, there's always that scenario that no one's pricing in, including me, that we're going to have a hard landing recession. And there's a few out there that still hold on to that. And maybe that is that's the idea that something's going to break here at some point. But we'll see.
So,
I still think for in the near term, there's still that risk that inflation could reignite in some way. But when we look at inflation expectations, when we look at commodity prices bouncing, when we look at what's kind of going on, but we shall see. So Tony, I don't know, any closing thoughts as we kind of wrap it up here, in anticipation. I mean, with anything that as we look through we're kind of halfway through earnings, but for the most part, we've seen the big names come out. We'll still see a few more, another busy week. But after the data, after the Fed, and after the big mega or top five, Fab Five, I guess they call them now, um, earnings news this past week, it seems like at this point, the people are going to make up their minds and it's just going to be on autopilot at barring some news. Anything you on your radar?
yes, the final thought will be on the US dollar. We started to see the strength of the US dollar since the beginning of this of January, and the stronger of the typical what had happened is the stronger of the US dollar actually get the support from the strong economy that actually leading to the stronger earning per share from the S&P 500 company. No, I think with the stronger dollar, definitely the equity market, especially S&P 500 company, will still see some kind of a support over there. So while we for the investor, especially institutional investors, look at the equity market and also the bond market, I think this stronger dollar here would definitely play a role in the worth of the looking at. Now, we down further emphasizing the importance. I think the volatility index here might be a second tool that investors should focus on. We have been on the extremely low level of the volatility index, for instance, VIX reading over there. Anything goes wrong can cause the sudden sudden hike in the volatility index. This is something the market hasn't really priced in, and this is always should, and in your words, stay vigilant, right? Very
I
important for investors, like over there. This is given this is situation, all of the good news have been priced in. All of the good news. What if something really goes wrong? Yeah.
I couldn't agree more. And you mentioned the yield curve before, Tony. The yield curve leads the VIX index by about 2.5 years. So if we do start to see And you sort of, with this re-steepening, it's kind of coming through it, and it's going to probably point to much higher volatility on a forward-looking basis. And so that's something that maybe next time we'll want to cover the U.S. dollar, the impact on emerging market stocks and maybe potentially commodities too. But
Yes,
we'll
sounds
uh,
good.
we'll take a look at that at that time. So thanks, Tony. Thanks for joining me.
Yeah,
Um,
thank you, Rich.
thanks to everyone who was listening. We went try to get through this, try to get through a lot of information in a short period of time, but we wanted to just kind of get out there and tell you what we're seeing about the Fed, about the earnings, and what we can be expecting in the markets going forward. So thanks for joining us on this latest edition of Macro Matters.
Yeah, thank you.